Good afternoon. This is Vrushali here. Today we are going to discuss an important topic in corporate finance, which is in the form of offering returns to shareholders. Typically, the CFO has three important decisions to consider: raising capital from different sources, investing the capital that has been raised in various projects that offer positive returns to the firm, and managing short-term assets and liabilities which get generated in the course of day-to-day business operations. Another decision which is also equally important is offering returns to the shareholders. The most common form of offering returns to the shareholders is in the form of paying dividends at regular intervals to shareholders. Simply put, dividends is nothing but appropriation or distribution of the profit earned by the firm during the current financial year or during preceding financial years to the shareholders. So the shareholders have another source of generating cash flows apart from the capital gains which they can realize by selling or trading the securities in the markets, in the open markets. So why do companies pay dividends? Many researchers, starting from Modigliani and Miller, have actually pointed out that paying dividends does not in any way alter the value of the firm. But empirical evidence has shown across the world, most firms do tend to pay dividends at regular intervals. So this brings us to a very interesting question, that if researchers have said dividend payment is not important, then why in practice do we actually see firms paying dividends at regular intervals? Many firms want to distinguish themselves, or profitable firms would want to distinguish themselves from firms which are not as profitable as they are. Also, firms would like to signal to the investors or to the larger stakeholders the quality of their earnings which are being reported, as well as guarantees about, or some form of guarantee about, future earnings, expected earnings in the future periods. So therefore, firms which would like to use dividends as a mechanism of distinguishing themselves from other firms, because firms which are managing or manipulating their earnings will not have a very good quality of earnings. Also, firms which expect their earnings to drop in future periods may not be able to pay very high dividends in the current financial period, and therefore payment of dividends by a firm acts as a credible signal about the future earning prospects for the firm. There are other reasons as well as to why managers would like to pay dividends. When a firm pays out dividends, dividends are usually paid out in the form of cash. So which means that the free cash which is available with the firm is reduced once the dividend is paid, and the managers would be forced to seek additional capital for any other investment projects. This sort of acts as a monitoring on the managerial decisions, and dividends therefore may be used to instill discipline in managers who may otherwise not utilize firm resources appropriately. Firms which have very high flotation costs when they try to access capital markets obviously would not like to access the capital markets repeatedly, or that is to say raise capital repeatedly, and they would first prefer to use internal resources to the extent possible. And therefore, we find that firms which face higher flotation costs usually tend to have lower dividend payments. It's also noticed that firms which have better governance indicators, such as diversity in their board structure, or having better auditors, being audited by one of the big four firms, etc., here the evidences are quite mixed. In some cases, dividends is seen as a substitute to good governance, and in some cases, it is observed that dividends and good governance characteristics complement each other. Few researchers have shown that firms which are well governed, the governance indicators itself act as a signal of their credibility, and therefore using dividends as a signal is not important, or may not be as important. But in other cases, it has been found that good governance and dividends complement each other, because good governance also indicates that the earnings are not being managed and the future earnings are likely to be expected to be higher. good governance also is another reason. In many cases, if the shareholders and the managers are similar or they're the same members, then there is lesser information asymmetry between insiders and outsiders as they are known. And therefore, using dividends to signal quality of the firm's earnings is not particularly important. So firms which have a greater deal of insider ownership are likelier to have lower dividend payout ratios. Firms which expect high sales growth in the future periods are likely to pay higher dividends. Also, firms which do not have large growth opportunities in the future would not need to reinvest existing profits, and therefore lack of growth opportunities leads to higher payments. Firms which have large growth opportunities are likelier to have lower dividend payments, as they would like to conserve existing resources and reinvest them in the upcoming projects. Also, the firm may have different types of shareholders. That is, you may have small retail investors and other institutional investors. There may also be a large number of family members who are investors. Now, the cash requirements of retail investors versus institutional investors and family members are likely to be different, and therefore cash flows required by these various categories of shareholders are also likely to influence the firm's dividend payment decisions. Taxation in various economies, the way dividends are taxed and the way capital gains are taxed are likely to be different. It is usually seen that capital gains is taxed at a lower rate than the normal dividends. So therefore, a firm which has a large number of high net worth investors or investors who pay a larger tax percentage, such kind of firms are likely to pay lower dividends so that the tax burden on their shareholders is minimum. On the other hand, firms which have small investors who do not pay large taxes, the firms are likely to have higher dividends. In case a firm is a member of a larger business group, then the interholdings and the interdependencies between these firms of a business group are likely to influence a firm's dividend policy. It has normally been seen that whenever a firm announces the dividend for the first time or increases dividends over time, markets are reacting positively to such announcements. Whereas any decrease in dividends as compared to the preceding financial years is usually interpreted by the market as a negative signal or an apprehension about earnings in the future, and therefore the markets usually react negatively to dividend cuts. So this is it about dividends. We'll talk about buybacks, which is another form of offering returns to stakeholders, in the next slot when we meet. So that's it. Signing off from here, Vrushali. Bye-bye.